Quick introductions, and then we'll plunge right in. On the end, we have Rob Cameron, who is the CEO and Global Head of Payment Acceptance at Barclays. We have Dr. Ruth Wandhöfer, member of the board of LSEG and permanent TSB and Pendo. 3 boards, huh?
You can't do more.
We have Tino, head of transaction banking solutions at Nordea, and Samish Kumar, the CEO of Transfast. Thank you for being here. I'd like to begin, if I may, by kind of taking a general view, and then we'll kind of get down into some specifics. Ruth, the infrastructure of cross-border payments has been in flux for several years now. We've seen a number of breakthroughs, innovation. I mean, the whole landscape has really changed, as I'm sure you've seen coming to many Sibos conferences. Give us a sense of state of play now. What are the biggest challenges, the biggest sources of friction in the system that you and professionals like yourself are tackling?
So if we think about the cross-border particularly, which is also then the B2B flows, more importantly, it was great to see that once Bitcoin arrived, people got a bit nervous about this extremely new technology and what it could do. And people went on a learning journey. And as a consequence of people getting a bit worried, lots of initiatives popped up. And of course, we've seen quite successfully in the last few years that the SWIFT GPI initiative has been picking up successfully and has actually done major improvements that could have been done arguably years ago. But there was a momentum where people felt, okay, before someone else eats our lunch, let's make sure the network works. But beyond that, I think we're now starting to move into an area where we see different models that can also deliver cross-border, whether it's low value, high value. We're starting to see, as outlined before, that there will be more choice. We're no longer only talking about card payments cross-border in the retail space. We talk about mobile wallets, account-based payments. It all combines with the real-time payment system evolution and how you interconnect those. So I think we will start to see a lot more momentum on things really working more interconnectively, and maybe in the longer run, underlying technologies such as distributed ledger could find a place there as well.
Okay, we'll dig into that a little bit. I wanted to turn to to PSD2, the Payment Services Directive, which is such a huge event that's still unfolding now in this space. It's really changing the way consumers and businesses manage their money, make payments, et cetera. And one of the big issues, you probably heard about this quite a bit in the conference so far, is customer authentication. We're now in the process, Rob, of implementing customer authentication under PSD2. Tell us about why that's such a challenging process.
Sure. I think what the core of the regulation says, in order to drive fraud out of the system, consumers and transactions are going to start to be interrupted, and there's going to be a second factor of authentication required. So, for example, it could be that you had to switch over to your app and get a code to enter into an e-commerce website, or it could even be that you have to use a PIN Sentry device, one of those little devices that you put your card into, similar to way if you're moving money through online banking, sometimes you're prompted. And obviously our retail customers were very concerned because the levels where that level of authentication was going to start kicking in starts at 30 euros. And then any transactions above that could be interrupted. And if you think about in the world of transactions, 98, 99, 99 point something of those transactions are actually good transactions. But our retailers were very concerned that this friction was going to cause abandonment in the flows. And so as an industry, one of the things we've been working on is how do we exempt low-risk transactions from these step-ups so that consumers don't have to go hunting around for a secondary code, and we don't drive abandonment. And really, we're talking about low friction. That standard could add friction to a large part of the transactions out there. So we've been
And by abandonment, you mean your customers will drop out and go somewhere else?
Yeah, some of our retailers thought that 10-15% of customers that were asked for a step up would just get confused and leave the transaction. And so for that reason, the industry, in the UK anyway, has an 18-month delay in when issuers are required to start declining transactions that don't follow the new regulation. However, we actually, from September 14th, we've actually started to see some of the step-ups have started to happen. So issuers have a rollout over 20 2020 to start actually stepping up the consumers. And one of the things that we're working actively on is, what are the flows and how do we exempt for our customers as many low-risk transactions as we can so that the customer journeys continue as before.
So is that a matter of writing software? I mean, does Barclays now commit developers to solving that problem? Do you partner with fintechs perhaps to address that?
We and other players in the ecosystem are developing different techniques. We've developed a piece of software which will basically score transactions inbound and allow customers to determine if it's high risk, maybe they kick it out. If it's medium risk, they step it up. And the low-risk transactions, they will just pass through. And we'll allow them to do that up to, based on the standard, a limit of 250 euros is how we're looking at it. And then above that, there may still be step-ups. But we're looking to try and also, from an app standpoint, working with our issuer, as the largest issuer in this country, we're working as well to talk about what are the most seamless flows for customers and transactions that do step up. Can we use our app to make it very seamless for the customer to authenticate and continue to transact? So we've got a little bit more time, but we're very engaged with the ecosystem because what we don't want to see is the same thing our retailers don't want to see, which is large abandonment rates in the system.
Tino, at Nordea, I don't know if PSD2 at that level falls under your remit, but can you just pick up on that?
Sure, because I think how I see it from a consumer perspective is that in the Nordics we are lucky that we already have the bank ID rolled out in all the countries. So one central bank ID for making payments, for submitting tax payments, etc. And with that single bank ID token, then you can authorize your payment through a two-factor authentication. So in a lot of cases, that is already quite frictionless. And as I think, and I agree with Rob, is that with the PSD2 implementation now, it is one step back, actually, unfortunately. And I think that's the industry.
Why is it one step back?
Well, in some cases, that you need to type in the text code.
Oh, the code.
Yes.
Yeah, I'm an HSBC customer. Sometimes they send me, please send
exactly,
me.
Exactly, and that's annoying, right? So I think from a consumer perspective, I totally agree that it is less frictionless. And in the Nordics, as I said, how I see it as from a consumer perspective, we are using the bank ID, and that is one of the, let's say, tools where you can, as a consumer perspective, make sure that your payment is authorized.
When you guys are leading the push for the cashless society, right?
Yeah, exactly. Exactly. So I truly don't wear a physical wallet anymore, only virtual cards. Yeah.
I see. What's at the top of your priority list right now when it comes to addressing kind of problems in the space?
So I think what we are doing in the Nordics, and you've probably heard about it, it's Project P27. It's basically creating a multi-currency, multi-country instant account-to-account service in the Nordics. So with that, we will be able to power commerce, basically. So as parallel with the cards rails, we will create an instant payment rails, which is truly multi-currency, multi-country. And with that,
is this for corporate clients or
both? It will be both. So it will truly also be cross-border and instantly as such. So and then obviously it will impact consumers, but it also will impact corporates at the end.
I see. Now, Transfast originated once upon a time as a remittance firm, but now you've expanded to become kind of a cross-border payment platform.
Right.
First, tell us just what does that mean exactly to be a cross-border payment platform? And then I'd love for you to kind of segue, if you could, into how being part of MasterCard has changed your life.
Sure.
Okay.
Okay. So from a platform standpoint, the way we kind of think about our business is really a sort of a stack of our network with its sort of reach and coverage globally. The second part of the stack, if you will, is our liquidity FX management capabilities across a whole host of currencies, both from a funding currency standpoint and a disbursement currency standpoint.
So do you actually have a brokerage, or?
Well, not so much a brokerage. I mean, we provide liquidity and FX management capabilities to our clients.
Okay.
And we're able to sort of actually transact, if you will, in these currencies to make sure that we're able to make both a funding and a disbursement currency available to our clients. The third part of the stack is our risk capabilities, which are both around transaction monitoring as well as ensuring that we are compliant jurisdictionally, whether it's an origination jurisdiction or a receive jurisdiction. And last, of course, but not least, is our sort of operations around the world. So this is the stack of capabilities we take to our clients around the world and provide them sort of via our APIs or an SFTP or a web-based solution. So what we're really trying to solve for is, given the sort of the overall theme here around frictionless, is our business model, first and foremost, we believe lends itself to a frictionless type environment in that the transaction doesn't really go through multiple hops when it originates and when it terminates. We can see the transaction throughout its life cycle. That's one. Another area of sort of solving for friction is around the regulatory side and the transaction monitoring side to ensure that we can make the experience, because we know what the requirements are. And particularly, I guess, in the world today and the world that we're probably entering, which is really a world of balkanization of sort of the regulatory environment, with more and more countries asserting their own rights around data, their own rights around AML policies, et cetera. So really understanding what those requirements are and solving for those on the origination side and on the termination side.
So your client knows you're going to take care of that.
Correct. So, I mean, they kind of rely on us to ensure that we're compliant with the laws that prevail in the origination jurisdiction or on the receive side.
Yeah. So do you compete? I mean, you're a different animal than Swift, but do you actually kind of compete with Swift, or are you kind of a frenemy of Swift, or what's?
Yeah, I mean, I think we just have a different business model. I think the Swift model is fit for, I suppose, their purpose, whereas we felt that we actually wanted to provide we want to deliver a model where we solve for specific pain points in the marketplace, and those pain points around transparency, around sort of convenience, around things like, I call it kind of the WYSIWYG phenomenon, which is what you see is what you get. When your customer is promised something from a payment standpoint, whether it's an FX rate, whether it's how much money the beneficiary, business or consumer will receive in their account, or the speed with which they're going to receive those funds, that we can actually help them deliver on that promise. So it's really, I mean, our model is different, but I think, that's their model.
Who would you say your number one competitor is?
I mean, I think, we sort of compete as well as partner with sort of a whole host of players in the industry. We partner with banks around the world.
Yeah.
They are our customers. We sort of help them solve problems that are unique to them.
Okay.
They might choose us for certain specific set of needs and choose another sort of model for other set of needs. So, I mean, our partners tend to be banks, financial institutions, non-bank financial institutions, as well as some sort of gig economy type companies and marketplaces.
And being part of MasterCard, I would presume all of a sudden you have a bunch of new potential partners.
Oh, yeah, absolutely. I mean, I think this is your sort of second question. Sort of a whole host of partners that we can actually work with and whom we can sort of solve problems for, but also a whole host of capabilities that we can weave into our solution and take to our clients. One of my colleagues, I think, is going to join later on today. We were talking at Cybos yesterday, and his product is around risk. And, this kind of goes to Frictionless earlier. His product capabilities potentially address some of the friction around, OTPs, et cetera, by leveraging machine learning, by leveraging artificial intelligence, so as to, in a preventive way, sort of assess whether or not a client who's about to transact should be allowed to transact. So, this whole question, given that 99.8% of the transactions are actually good transactions, let's not have the 0.2% destroy the experience for the others.
Okay. I presume most of us are familiar with Swift GPI. Could I just have a show of hands of everyone who kind of to figure it this out? Yeah, so I'd like to kind of pivot to that because it's been a pretty big event, Ruth, as you pointed out, the development of GPI, and they were kind of spurred to do it by Ripple and some of the DLT. All of a sudden, Swift said, okay, we better do something here, and so they kicked out GPI. What is GPI really a game changer in cross-border payments, or is it kind of a stopgap that Swift kicked out, and now they're kind of racing to iterate as they
Well, if I think about, through my ex-Korean city for more than a decade, the frictions that we have had in cross-border payments for decades were always related to bottlenecks, payments being stopped, you don't know where they were stopped, where they were delayed. And of course, that incredible risk if you have high-value transactions moving between the banks on the book entry level, that if one goes down, the other is not being paid out, and sort of you could have a Lehman scenario in the sense of people waiting for funds and nothing happening. And so that sort of, for me, from a financial stability perspective, that was the reason why I did some research with the Swift Institute last year and why we came up with different solutions that could address this problem. And GPI was the most obvious one because it didn't require a big technology implementation. It was literally leveraging APIs, tagging people, putting an identity on the transaction, which is a big move from the board to mandate this unique identifier.
So you could track it like an Amazon package.
And you track it like an Amazon, and you know exactly where it stops. If something's going on, you can call up the bank and say, what's going on, guys? Is there a problem with your systems? Do you have a liquidity incident? What is the reason that this payment is not?
Can you load a GPI message with a lot of data, like context for the payment? Because I know that was always a big problem.
Yeah, and I would say, so on average, the majority of payments are now going through even within an hour, certainly within a day. And you can really see the incremental levels that are taking longer are due to the regulatory requirements such as paper invoicing, stamps, if you think about certain countries that have stricter rules on this. And these rules, of course, don't go away. You just have to wait longer, but at least you know the reason why. So you can quite clearly determine which corridors and destinations might have more friction, and this friction is unlikely to go away quickly. So from that perspective, it was a success because actually people were forced to include the identity. Everyone has to participate, so that decision-making made a big difference on a governance level from Swift. And they leveraged API technology, which is, of course, something we see in open banking and many other initiatives today. I think as we move to that next step, I mean, Swift is still messaging. We talk about liquidity management, FX. I think for me, the big question is how can we arrive at cross-border solutions, potentially multiple systems that serve that, not only one, but that can look at real-time payments and actual flows and actual real-time FX. So to get more transparency and more speed into the transaction and start to take out, where possible, the credit line element. If you do it on credit lines, there's always a credit risk. Can you just increase the velocity of cash around the world by doing something at the infrastructure layer, give more transparency, and ultimately end up in a situation where you can afford to pre-fund. So once you hit a button to send the transaction, a bit like in Bitcoin, the money is actually ring-fenced and will go. And you don't need to rely on another partner to supply credit. So it depends on the large and small entities, but as you're starting to move potentially into real infrastructure changes that are much more real-time, with digital assets being created and transacted on a ledger, as an example, you could arrive at that scenario, and that would be incredibly interesting.
So there is still a great potential for distributed ledger technology to disrupt cross-border payments, is that right?
Longer term, I mean, there's a lot of change in the technology layers, and we will start to see which ones will be successful. So we're not at any early deployment stage, but the market is continuing to evolve in that space. Yeah.
I would say complement, really.
Complement.
Well, sorry.
No, go ahead.
I was just going to say, I mean, I think from a distributed ledger standpoint, I think it could solve various areas of friction in a sort of a multi-party system in areas, for instance, like liquidity and FX management. So, I mean, I'm not sure it's necessarily just disruptive. It could equally be sort of very additive to the model, to current models. And I think the ability of current players to adopt distributed ledger, I think, makes their value proposition that much more attractive because they already have networks with various participants who are currently active on the network. At least that's kind of how we feel.
How do you size up then the potential of Libra, which is probably the big DLT story of the year so far. How do you size up the potential, Rob?
I think for any of these to work, you need ubiquity for consumers in terms of acceptance, and Facebook entering the crypto kind of legitimize, and they bring their massive number of consumers that have Facebook accounts. So I think that led to a lot of excitement, but there's a big gap from the here to there around how do you get people to start to use the currency, how do you drive acceptance, where are the initial points that it starts out. I think that you've seen they've partnered with banks. I think that Visa, MasterCard have at least dipped in. So is it just a load factor from cards into this crypto, or do we actually start transacting and leaving in the currency? So I think it has potential because it's got such a brand, but there's a lot of work around how do you treat customers fairly? How do you know that the consumers who they say they are, and deal with the regulatory elements that banks are very, very good at.
That's kind of the big factor.
Right?
There's
a lot of that needs to be solved before you end up with this panacea of a crypto, no currency conversion, any payment anywhere scenario.
I mean, you have that nexus with fiat currency. So unlike Bitcoin, which is a private crypto created in code, and you can mine within the system, so you don't necessarily need to do fiat in and out. This is based on a fiat basket with other assets that are considered eligible, but we just don't know what they are.
It's a stable coin pegged to a basket of other currencies and securities.
Yeah, it's a stable coin. And I mean, I guess my perspective was Facebook Messenger already had a payment tool, which people didn't use big time. Of course, Facebook doing this bigger alliance looks like it could take off because you have actually merchants and platforms involved, and therefore you have the incentives in the system. But it still really would need to be incredibly frictionless, because why would I change my money into some other money to then use it within a network?
It has to be invisible and seamless.
And it has to be incredibly. But the central banks, coming back to the regulatory question, there's a question around monetary sovereignty in terms of if larger amounts were to be transacted. How do you determine which currency you include in the basket? I mean, this is a geopolitical currency question to a certain extent. How do you update that? I mean, the eligible securities is a big question from my perspective. We've seen, Greece haircuts could suddenly happen. I mean, just as an example. And of course, right now, the central banks are all actually agreeing if Libra were to come in play, we need, as a community, to be ready with a regulatory framework before they switch it on. So unlike FSB, I mean, all of these guys play a role in Basel implementation, but we have incredible fragmentation around the world with many of the prudential and other rules. On that particular Facebook case, they actually all huddled together, and there was recently a conference at the Bank of England, said, we, within the FSB Basel Committee, need to actually have a response to this that is really coherent, because you cannot have cherry picking, because then you end up with strange mixes in the currency basket in terms of which countries are okay with it and which countries are not. So you need to have a line in the sand on how you will deal with it.
Could a country actually stop Facebook from putting its currency in the basket? I don't think it could.
Well, I mean, the question is exactly what is the governance around this? And we have seen high-level things, but we have not seen technology. It's not even clear exactly what this is. So there's a lot of unanswered questions here.
Okay. I think one of the most striking stories to develop out of everything we're discussing on payments, especially cross-border payments, is speed. Just how fast payments are now being processed. And I'd like each of you, if you could, just to cast your minds forward and kind of imagine what this space looks like, say, a couple years from now. I mean, we're through the 18 months on the customer authentication, where PSD2 is very far along, and they're already talking about PSD3. I mean, what does this look like in a couple of years? Tino?
Yeah, and not even in a couple of years. I think what we're focusing on is very much on frictionless receivables. So not so much payments, but I think from a consumer and corporate perspective.
Receivables meaning?
Meaning that you understand that you have the funds available for you on your account. That you have a notification if large treasury payments come in or high-value payments come into your accounts, that you are notified immediately. So for me, yes, we need to have a frictionless initiation of the payment. And obviously, an end-to-end chain, it has to be secure and fast. But I think more important, especially for merchants and corporates, is that they have instant reporting. And I think that is one of the things we are delivering, making sure that our customers see that the funds have arrived and that they can start using that fund. So I think that's an angle that we are, from a Nordea perspective, are looking at as well. Is making sure that our corporates can have frictionless accounts receivables, because that has been, from a corporate perspective, quite a challenge in the past 10 or 20 years I'm in the business, and I think that is one of the things we try to help them. Yeah?
I mean, the one thing about faster payments generally, I think, is I'm not sure the limitations around technology. I think there are often limitations around vested interests. There are many countries in emerging markets, as an example, maybe not even emerging, some developed countries, where there really isn't necessarily a rush to adopt real-time payments that are instant, because it comes at a cost. At a cost, certain benefits to maybe the end beneficiary, if you're a business looking to receive money, but at a cost to some of the participants, because suddenly you don't actually have access to significant float. And so there are countries in emerging in economies where there are clearing systems that work very well, yet many institutions perhaps don't embrace them very quickly. So I think issues or areas of kind of friction, if you will, are not necessarily technology, not always regulation, but also certain set of incentives or that prevent perhaps some of these payments to, kind of be seamless and be instantaneous.
We see that with open banking taking off in some markets because there's a regulatory push combined with real-time payment systems. Other markets that say, oh yeah, let's have an open banking initiative.
I mean, adoption's really uneven.
But if you have a concentrated market with no incentive, where there's a few players sharing the pie, and you really don't let others in because your infrastructure doesn't allow access for non-banks, etc., you're really not setting yourself up for that disruption. And unless a government takes the action and says, for economic reasons, we want faster, better, more data, and more opening up to allow for competition, nothing will happen. And we see that in a number of countries around the world.
That's really interesting, because this is going to come up in the next panel, but I think it's in emerging markets where we see the huge exponential benefits of mobile banking, of technology, of speed, and so forth, where it's really needed. And if there's blockages, if there's resistance in those, that's interesting.
Well, I think in the United States today, if you do a domestic payment, it takes longer than for us to move 90-some% of our payments cross-border.
Don't talk about checks. As much as 10 days.
Personal checks?
Yeah.
And I think Europe, and with the open banking environment, if you look at the UK, there will be more choices. So if I fast forward, today, the payment instrument I use as a consumer to pay dictates whether I pay now or pay later. But I think what'll change over the next few years is, as a consumer, you'll get to the checkout, and it won't matter the instrument sitting behind. You can choose whether you pay it now in one, or whether you'll be able to pay it in 4 installments, or maybe over 3 months or 30 days. So you'll make that choice. We call it checkout choices, but we think there'll be a lot more choice for the consumer, regardless of the instrument. And retailers will want to give that flexibility to their consumers, because giving someone the ability to pay over 4 installments might be far more efficient than giving a 15% discount in order to encourage them to transact with you. So
that sounds amazingly nimble, but also sounds like such a headache to manage. I mean, that much customization.
I don't know that it drives customization. I think in the right environments, you can reserve the funds and make it very seamless for customers. I think that's what customers are.
That's something Barclays is working on, like you're looking at?
Absolutely.
Okay.
You got the data analytics in terms of managing the risk. So suddenly you can extend real-time credit because you know the customer, you have open banking, you're using the data you never used before. And so it's all seamless because you've got a good picture.
Now you're scaring me. Okay. I think that's, we're kind of at our time limit here, according to this clock right here. What a fascinating discussion. Thank you so much. Would everybody please give a big round of applause to Rob, Ruth, Samish, and Tino.